Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake, coming to you from Duquesne Hall, right here in the heart of Foggy Bottom. GW School of Business, GW Investment Institute show. Today, we're going to dive into a company that probably many of you have not heard about. It is called Emerson Electric. It is in one of our portfolios at the GW Investment Institute. Disclaimer, educational and entertainment purposes only here. But this is a company that maybe is a divergence in the fact that you probably haven't heard of this. You probably don't interact with this company. You've heard of NVIDIA, you've heard of Apple, you've heard of Coca-Cola, these consumer-facing companies and products you know and use in many cases. So you have some idea about this. This is an industrial company. It's in our industrial sector. So we cover many sectors in our portfolios. We put them into 6, and our students pick those companies in that portfolio, or all of our portfolios. And so Emerson Electric. So we're going to talk about Emerson Electric. You might not have heard about this company. The ticker is EMR. But we're going to go through, and as you know, if you've been following the show, and welcome back to the people who've been watching, and welcome to the new people, we're going to use the GW Investment Institute framework: business, management, price valuation, and balance sheet to cover this. Excuse me. So, Emerson Electric, what is this business? Now, we own it. Again, it's in our industrial sector, so it is an industrial company. They manufacture and design electrical and electrical equipment, software systems, and services for utilities, industrial, commercial, consumer markets. It's a global company. We'll get into some stats here. So what are some of the stats for the company? So if you look at, let's start, as we many times do, to talk about, the high-level things. So when we talk about Emerson Electric, what's the market cap for Emerson? So the market cap, and we're in early June 3rd, when we're recording this one, is $67 billion. So this is not a tech giant. This is not a $1 trillion company. This is not even a $100 billion company. But it's not a small company. $67 billion is not a small company. I guess today, maybe that's we should revise some of what that means, given how big some of these companies have gotten. NVIDIA, Apple, Microsoft, Amazon, and the like. But not a small company, $67 billion. And we'll get into the business here. And so why are we talking about industrials? So one of the reasons that I wanted to talk about industrials is because there is so much talk about artificial intelligence. But behind that has to be all the things that have to work for artificial intelligence. And so obviously the grid has to work. All the electrical systems have to work because all these data centers consume lots of power. And so Emerson Electric is absolutely part of that network and absolutely part of that world. And so this would be a derivative play, let's say, of AI. But certainly as that becomes more important, Emerson Electric is likely to become more important in that fabric of AI. And it's been doing well in any case over the years. But I think it's time to focus in on that. We're coming into industrials now. We may or may not cover every single company that we own at any given time, but we're going to try to cover a lot of our companies in our portfolio. But we've been, again, talking about a lot of tech companies and a lot of consumer. So here we are safely in the industrial sector at the moment. Again, market cap, $67 billion for Emerson. But let's talk about the business. So let's get into their financial statements. And so when we talk about how big they are, $67 billion, that is the market cap. But let's look at the revenue. What does that mean? So the revenue for this company through March 2025 is $17 billion. And the full year of 24, their fiscal year ends in September, $17 billion, almost $17.5 billion. And so this company, again, is a large company, but not super massive. And what's been the revenue growth? So as we talk about, too, we're going to try to look at this over the years. So if you look at 21, 22, 23, 24, and then the trailing 12 months, back in 21, you had negative. So you're minus 23. So really bad shape. They look like they turned it around, plus 6.7, plus 9.9 into 23, plus 15 into 24. So really good year there. And we'll talk about some of that and what's been happening with the company. But now you're at $17.6 billion for the last 12 months through March 31st, 2025, and a 6.5% growth rate. Not fantastic. Certainly way down from the full year number for last year for the fiscal year 24. And you're projecting for the full year for 25 fiscal year, which ends in the 930, is 3.4. And then the projected for 26, this is Wall Street consensus, 4.9. So 3.4, 4.9. So these are not enormous growth rates. So, well, we'll talk about it. And that's this is the business. Industrial companies are not going to grow like tech companies unless they have some tech components, which we'll get to. Now, we often talk about the gross profits and the net profits, which we're going to do right here. So what are the gross profits for this business? So if you look at the gross profits, again, this is an industrial company, but you may be surprised by these numbers. So the gross profits are 52%, and the net profits are more pedestrian, let's say, for industrials at 13%. And so that's obviously a big difference. But they have excellent gross margins, and I think that that's important. And they've grown those over time, and we'll get into that because one of their acquisitions really has been helping with that. And if you look at, again, we try to look at these metrics over time. You don't want to look at it just 1 year because that may not tell the story, how the company is growing, how the company is evolving, what is management doing on the capital allocation side, which we'll get into. But if you look at the gross margins over time from 21, 22, 23, 24, you're looking at 44, then 45, then 49, then 50, now 52, almost 53%, projected to stay right around 52% for the next 2 years. That is excellent. And obviously, they had a shift, right? So if you go back from 21 and you look at now, you're going from 44 to 52. That's excellent. And especially for such a large company, $67 billion market cap, you can't necessarily do that overnight. And that's excellent. If you just see that information, you would probably say, well, that is absolutely a positive check for management, which we haven't gotten to yet. We're still in the business, but certainly that is an indicator that management is doing something right if they can grow their gross margins. Meanwhile, they've been growing their market cap, $56 billion in 2021 and $67 billion now. So obviously, you typically get a higher margin or higher multiple if you have higher margins. And so maybe that's what happened. And we'll look at that as well when we get into the price versus valuation. So these are good. But then we get down to the net income here and you talk about the profit margins. So the gross margins, 9.2 billion and then 2.3 billion for through September 31, 2025. So again, high gross margins, pretty low net margins, 13.2, $2.3 billion in net income. And for the full year, fiscal year last year, 1.9 billion, and that's 11%. So the trailing 12 months is slightly higher than that, but let's look at the net margins over that period. So 21 to 22, 21 was 11, and then it goes to almost 16, and then basically stayed at 16 for 23. And for the full year 24, we talked about 11, and it's improving. Now, the expectation, though, is that for 25 and 26, again, this is consensus estimates here, you're going to 18 and 19. So that's very positive. And so when you look at that, that's fantastic. Now, let's also talk about the free cash flow for this business. For the trailing 12 months for March 31, you're talking about 2.8 billion. So not terrific, but certainly not bad. But let's look at it over time. You're looking at 21 to 25, 3.1 billion in free cash flow, 2.6 in 22. Then a major decrease here, 274 million in 2023, back up to 2.9 in 2024, and now for the trailing 12 months through March 31, 2.8. Projected 3.1 and 3.6 for 25 and 26. So pretty good. These are not extraordinary numbers. So when we talk about what's our number, what's our score for the business side of this, you're probably going to talk about something like maybe a 7 here, right? So we'll put this safely in the 7 category. We certainly would like those numbers to be a little bit better on the net margin side. The numbers are moving in the right direction. So that says something about management, which we're going to get to next, but that's very positive. All right, so now 7 on the business. Now we're moving on to management. Now, the CEO has been there a long time, and he's been in the spot for about 4.5 years as the CEO. Karsan Bhai, I'm probably saying it wrong, Lar Karsan Bhai, his last name may elude me the correct pronunciation, but has been there a long time at the company and about 4.5 years as CEO. And I would say one of the most significant things that they have done is the acquisition for the Aspen Technologies. And so this has certainly made them much more like a industrial company that's moving in to more digital solutions for their business. And that has made a big difference. And you can see it, those margins have grown. That's super important. So when we talk about, okay, well, what's happening with the business? This is, this, process and asset optimization software. They did this acquisition very recently, just this past year, closed in March, and so we'll see how this turns out. But this is absolutely the future and the direction for Emerson, and this is something that's really important for us to pay attention to. So you have an industrial company, and we've talked about this before. That many companies now, if you think about it, they're all just tech companies. Because if you're not focused on how do you incorporate new technology, how do you stay innovative, you're going to be out, right? You're going to get outcompeted. Tech is moving too fast. All these solutions are moving too fast. And if you're not keeping up, that means you're way behind. And if you're not pushing forward, that means you're way behind. And it only takes, a couple years, and now it could happen even faster, where you fall back against your competitors. And so, what is Emerson doing with respect to that? They bought this Aspen Technologies in the asset optimization space, and they sell that software to their clients. Now, I think it's super important to think about, how does that work, and why would an industrial company buy a software company? But their customers have these big plants. They have these, big systems, power plants. They're going to need, ways to optimize those systems, ways to optimize that equipment, and that software is really going to help them do that over time. And again, this is a much higher margin business than the industrials. And when we go back and we just take a quick look at, excuse me, what's happening with respect to the margins, you can see that the margins are moving up. And again, back in 2021, we were at 44%, and now we're almost at 53% for the trailing 12 months, projected to stay at 52% on the gross margin side. And then even the net margins are now moving back up, and you're looking at 18% and 19%. Now, this acquisition was just fully done in March. So you can probably say that, well, okay, there's maybe some obvious connection between going from 13 to almost 19 and 19 and 26 from this business, because software, as we've talked about when we talk about software companies, is a very high margin business. And so when you add that to the equation, if you don't, increase the other components of the business as fast, and that outpaces the growth internally, which maybe it looks like it's projected to do, then the margins are going to improve. That's the basic math of the contribution to those margins. And so that looks good. Now, we'll have to pay close attention. Can they integrate this properly? Can they achieve those margins? So I think everybody talks about cost synergies when these types of acquisitions happen. But I do think it's really the top thing that I will be paying attention to for management is this acquisition. And so, number one, we talk about management is capital allocation. These are the people who are in charge of the money for the business. And so it starts with the CEO, and you have to say, what are they spending this money on? And in this case, a major acquisition, a big addition to the business, just closed recently in March. And we should be, as investors, as analysts, as business people, we should pay close attention to how this turns out. Are they going to get those synergies, which will flow through to the margins? Are they going to get the synergies on the customers? Are they going to get this increase for the revenues that they're expecting? Now, so far, so good, but it's early days. And again, for the number one thing as analysts right now, and certainly we'll be asking our students when we get back to class in the fall to check out, is what's happening with this acquisition with respect to the overall company. And then we can really understand how effective management has been. It just happened, so it's very difficult to tell. Certainly, we've been existing shareholders for this company for a while, so we're optimistic about this. Excuse me. And I think it's important for us to pay close attention and evaluate it on its own as we move forward. But because the reason to focus on this also is because it is a divergence from the traditional business. Now, the clients are in the same place, but it is a different type of business, the software business versus the traditional industrial business. So the number one thing, again, to pay attention to on the management side is this acquisition about Aspen Technologies. So a couple of other things to mention, though, on the side of management, this is a dividend payer, and so you've had a pretty good dividend for this company, 1.75% right now as we sit here in early June of 2025. growing at 1.15% over the last 5 years. So you're not something that you're going to say like, oh, this has been great. But steady dividend payer certainly over time. Important for us to pay attention to. Not going to make or break the investment thesis for us necessarily. But 1.75 is still a substantial dividend. And certainly as part of the equation, we want to make sure that we're aware of that, what that is, what's the outlook for that, is it stable? The answer is yes to those things. But the dividends have not been growing, at least over the last 5 years, much more, certainly less than GDP at this pace. So, all right, well, let's get into the next component then. So management, let's score management before we move on. I would also give management an 8 right now. It looks like they're transforming the business. I do think the caveat there is that we got to pay close attention to what's happened on that capital allocation side. What is happening with this big acquisition of Aspen Technologies? This could obviously transform the business, but we got to pay close attention. So that's an 8 for now. With the caveat, we got to watch that closely. Let's move on to the valuation for the company and the price versus valuation. So if we look at this, this company is not cheap. So when we look at an industrial company and you think, well, the gross margins are high, but the net margins are, maybe going to get better. But you're right now, again, in June, you're paying 30 times for the forward. So that's not, that's high. The trailing and the forward, at 20 times. So certainly we're projecting good things for this company. But for an industrial company, that's not great. And so we'll have to pay close attention to this. I would give this, if you're paying 20 times, you're kind of around an average score for the market. 21 times might be the overall S&P right now. And I would rate this as a better company. So we could probably give this a 7 on the price valuation. If you look at, where is it, relative to over time? In the last 10 years, if you look at the PE for the valuation, you've had a high of 41. We certainly are not there. And the low of 12, and we're not there. And the average is 24, and the median's 23. And so we're kind of right there. We're a little bit below the average in the medians for the forward PE, which is the one that we care about. And so nothing crazy. I wouldn't call it historically cheap by a lot, and certainly, but not expensive. Kind of maybe fairly valued to slightly less than that if you're looking at the forward PE for this only. But okay, well they gotta achieve these margins. So these things are all interrelated, as you know, and so we got to make sure that they hit on the things that have to be done for that acquisition, is with respect to the cost synergies, with the expected revenue growth to justify that, and certainly the 20 times could be even better then. So we'll have to see what happens there. But overall, that's probably a 7 as well. All right, so now let's move on to the balance sheet. So what's happening with the balance sheet for Emerson? And so here is where we have some concern. So it's a big industrial company, so having some debt is not a huge surprise. But if you, as we mentioned too, look at these things over time. But let's take the snapshot first, which is a balance sheet. 1.9 billion in cash, 15 billion in debt. So a lot of net debt here. Even if we're generous, we'll call it 13 billion in net debt on the cash position, generating 2.8 billion in cash. So again, that's not great. That doesn't help us sleep at night. We like to be in the net cash position for the investment institute. But all right, so how should we think about this? Well, let's look at the balance sheet over time. So back in 2021, 2.3 billion in cash, 7.2 billion in debt, a much more manageable net debt situation there, right? Even you say, okay, well, let's be very generous with the numbers here and say it's just 5 to make it an even. So a net debt 5 billion, generating back then 3.1 billion in free cash flow. That's not something that we would be super concerned about. But here we are. It's levered up, and this is not great, right? So the year over year, the fiscal year 930, 8.3, and then now for the March 31, 15 billion in debt. So that's a big change, obviously connected to the big acquisition. And so this is something that we have to be aware of. This is something that we have to pay close attention to. Excuse me. That's not great. Now, can they pay that debt down over time? The projection is the free cash flow will pick up again, 3.1, 3.6, and 25 and 26 respectively, but it's not great. Now, one of the things that we ask our analysts to check and that we should check here is, okay, well, what is that for the interest coverage ratio? We like to be 10 plus. This is 6.5. So that is, remember, EBIT, earnings before interest and tax over interest expense. And so 6.5 is not horrible, but it's not great. We certainly like to be closer to that 10 number to help us sleep a little bit at night. So probably going to give the balance sheet a 6 here. And so if you pull those scores together, and you can go up and down a little bit here and there for those scores, but you're probably looking at a 6.75, or let's say a 7 if we just average some of them out. And so the company overall is a 7. The thing to watch is really on the balance sheet. Watch what's happening with management. We got to pay close attention. Is this a transformative acquisition? Is Emerson going to get to participate in this AI, boom time, have their place in that whole setup? Are they able to get those higher margins from this digital solution business, Aspen Technologies? Time will tell. We'll be asking our analysts to pay close attention to what is happening there, and that is something that we'll be kicking off the fall semester with. That's it for this episode. For Market News with Rodney Lake, we'll see you back on the next episode. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.